All right, so that's what we have. Let's get in some perspective now. Cameron Brandt is Director of Research at EPFR Global, and Ed Yardeni is President at Yardeni Research. Gentlemen, great to have both of you with us here. Thank you very much for your time. Cameron, you publish your data on Thursdays, right? The data for the prior week. EM equities, equity funds have been seeing outflows. I think we saw outflows. The last number we have is for 8 straight weeks we've seen outflows. What happened as part of the latest data, EM funds?
Well, actually, that's that isn't quite the number. We've actually seen, I think, getting on for 7 weeks of inflows at a headline level, but that's a deceptive number. It's sort of staying in positive territory largely because of institutional flows to China equity funds. However, I would say the opposite is also true, that we're definitely not seeing the sort of levels of angst and risk reduction in the emerging markets equity space that we're seeing in some of the other asset class groups.
Just, sorry, the number, the EM equity funds, the number I have is, I'm talking about equity funds, not overall. We've had strong outflows, right? I mean, this is...
are you talking about is this dedicated to India?
No, I'm talking about the emerging market equity universe. And bulk of that outflow has come from not regional funds, but GEM funds. And it's been the longest streak of outflow since pandemic. I mean, March or April of 2020. Yeah, that's what I was referring to.
That's true. That, the diversified global emerging markets funds have been on a rough losing streak, and that isn't good for India because India has actually benefited, if that's the right word at this point, to a fairly big degree from the scrambled reallocation of Russian exposure that happened towards the end of the first quarter. So India's stock with global emerging markets funds is high. Unfortunately, global emerging markets funds don't have money to back up that conviction at the moment.
Okay, well, Ed Yardeni is also with us to give us his view. Ed, morning, and thanks for joining us on the channel. It's a given that now there are more rate hikes coming from the US after the reading into the September Fed minutes as well as the inflation print. But how much of that you think is in the price already? And how did you read into the sharp pullback that we saw overnight in the US?
Yeah, I think to a large extent, a lot of the bad news is in the market. As you said, we had several days where the market was down. And I think during those days, a lot of portfolio managers may very well have hedged their positions, fearing that the CPI might be surprisingly bad again. We've had a few times when that happened this year, and the market took a big dive and stayed down. This time around, I think what happened is that so much hedging had occurred that when the CPI did in fact come out stronger than expected, more inflation than expected, that a lot of those hedges were covered because they worked quite well. And then, of course, some of the people who were actually outright short without any hedge had to cover. So it was a heck of a reversal day today. And I think it's going to make it harder for anyone to short this market anticipating bad news because it is so prone to these technical reversals. And so I really think that the June 16th low, which was 3,666, is turning out to be sort of roughly the bottom of this trading range that I see through the end of the year. And I think the upper end of the trading range is 43.05 on the S&P 500, which is where we were on August 16th.
Hi, Mr. Yardeni. Well, we've got that, and good to hear that June 2022 lows could hold out in your opinion, so that's pretty good news. I want a couple of data points from you. Post this red-hot CPI inflation number that we have got, do you believe that could be 275 basis point rate hikes in the upcoming meets? Earlier, I think you were factoring in around 125 basis points. So what's your take on that? And also, I recall we were talking about the hawkish and the dovish pivot. Well, no signs of the dovish one from the Fed yet, right?
No, not really. that's what's really been quite extraordinary is the committee just seems completely united, seems like groupthink, not even one significant dissenter from what the crowd of FOMC folks are saying. I think it's pretty well anticipated. I think it's consensus that 75 basis points is what the Fed's going to do at the early November meeting, and that there might be another 50 basis points at the December meeting, and there might be one more hike early next year. But I think the market is starting to sense that we're getting closer to the Fed accomplishing what it wanted to accomplish, which is to get the Fed funds rate closer to 5%, which they view as restrictive, and then keeping it there. I think Fed officials were somewhat concerned a few weeks back when the market seemed to believe that the Fed would be lowering interest rates next year, and they wanted to make sure that that isn't the message they were sending. So I think the message that they've made quite clear is they intend to have a few more rate hikes, get it to restrictive and keep it there. I don't think it's going to be the kind of tightening that we saw with Paul Volcker, where interest rates were just allowed to go to whatever level it took to cause a recession and bring inflation down. I don't think they're going to go that route.
Okay, well, on that note, we'll thank both of you for joining in. I think the market is also looking at it like that. That's Ed Yardeni of Yardeni Research saying that the June 16th low of the S&P 500 could hold as a base for the rest of the year. And the market is pretty much priced in a lot of the bad news with respect to inflation as well as rate hikes. Let's slip into a quick break. But when we come back from the break, our entire research team will be with us to help us talk about the top 10 stocks that are in focus this morning. Stay tuned.